everybody, welcome back to the channel. We are back on another episode of the Daily Recap. We are ending out the week with today's episode. The stock market will be closed for Good Friday tomorrow. We still have a lot of things to talk about. Jerome Powell and Trump, it is turning into a literal movie. Like, actually, we got a lot of digging into what happened today between Powell and Trump. We got Netflix earnings that has officially kicked off big tech. TLDR, very good earnings, even if the stock is only up 2-3% after hours, a phenomenal earnings. And then we got some more updates on Nvidia, United Healthcare, Eli Lilly, Charles Schwab, lots to get into. Let's get into it. All right, let's get started with our first story of the day. Trump and J. Powell. Now, what was the big headline today? The Wall Street Journal reported that Trump has been secretly thinking for the past couple weeks and having meetings with his cabinet officials on giving J. Powell the boot, firing Mr. Jerome Powell. Now, why does Trump want to do this? We've been talking about this on the show for the past couple of days. Trump wants rates to go lower. It would be good for mortgages, auto loans, obviously refinancing the debt that we have right now, about $9.5 trillion due in the next couple months. And if we could refinance it at a lower rate, that would be a good thing. Jay Powell, chair of the Fed, is afraid that the tariffs that Trump wants to impose across the entire world are going to be so inflationary that if he were to cut right now, which would be stimulatory for the country, and that would be like getting people to spend more money because the cost of capital would be cheaper, that the tariff inflation would offset the rate cuts and we would actually have more inflation. And that's the fundamental ideological disagreement right now between Trump and Jay Powell. Now, Jay Powell thinks that if we get into a recession because of tariffs, aka growth slows down because the tariffs make it harder for people to buy different products and overall business activity comes down, that's not his fault. He thinks that's Trump's fault. Trump's argument is like, hey, I know it's going to be blamed on me. So one of the ways that you can soften my blow, and hopefully we don't get a blow, is by you lowering the rates. And I think Jay Powell basically feels like this is not his problem. This is Trump's problem because he doesn't think the tariffs are necessary in the first place. He has not said that. He's just kind of reacting to the nature of tariffs. But you can obviously tell if you read between the lines, Jay Powell's not a fan of the tariff volatility. So what's the easiest way to resolve this? Get rid of the guy. The problem is in America, in the democracy that we have, the president of the United States is not allowed technically to remove a official from a political agency, which is the Federal Reserve. And so Trump has been thinking, are there any loopholes? Are there any court arguments, any precedents I can use to be able to justify getting rid of Jay Powell? And to be honest, there are. And he said today, quote, if I wanted to get rid of him, he would be gone fast. He like legitimately said that, which was crazy for me to hear because I'm like, oh, he's not joking around. Like he actually wants to get rid of the guy. But no one's ever done it. And unless Jay Powell had a scandal or something like really crazy, some criminal negligence, it would be hard to justify it. Now, who talked him off the edge? Scott Bessent. That is what the Wall Street Journal article said today. They said, hey, Scott Bessent has been meeting with Trump privately in the Oval Office and at Mar-a-Lago. Bessent did admit to having breakfast with Jay Powell every week as well, a couple of days ago in the Bloomberg interview. And Bessent's been telling Trump, you cannot do this. The bond market's going to freak out. We had yields surge a little higher today on the 10-year and the 30-year. And the stock market's going to freak out because, I mean, theoretically, why would foreign investors want to invest in America if the chair of monetary policy can easily be replaced from administration to administration? Where's the consistency? Even if you even agree that he should be replaced, there's probably a lot of hedge fund managers in the world that don't like what Jay Powell's been doing. The precedent that it sets by getting rid of the guy, probably not the best precedent ever. And I think Bessent knows that because he's been in the money management business all of his life. So he kind of talked Trump out of it. But the article did say that Trump is still pretty convinced of doing this if Jay Powell doesn't switch anytime soon. I don't think we're going to get a cut in May. I think we're probably going to get a cut in June. And maybe if Trump is patient enough for that cut in June, assuming that the Fed doesn't think that the tariff inflation is going to be that bad going into June, then he'll be okay with it. And he'll let Jay Powell finish out his term until May 2026. I'm going to say it right now. If Jay Powell doesn't cut in June, I think Trump will legitimately try to take legal action, which probably would go to the Supreme Court to get rid of Jerome Powell. And if he does that, I think that will cause a shock to markets. I don't think that, creates a bear market or anything, but you're going to have equities and equity investors be like, dude, what's going on? Like the one thing we can't handle is uncertainty. 2025 has been defined by uncertainty. Getting rid of the chair of the Fed before his term ends, which is unprecedented, would create a lot of uncertainty and volatility. Now, who is he trying to replace him with? Kevin Warsh, who is a former Fed governor. I actually know Kevin Warsh based on his interview with Palantir's Alex Karp back in January of 2022. Some of the people might that are watching might have remembered that interview. That's when Karp was spinning the book on his finger. So I'm a fan of Kevin Warsh. I like the guy. I've studied him a bit before in the past. I understand kind of the way he thinks about monetary policy. But the Wall Street Journal article even said that Kevin Warsh told Trump at Mar-a-Lago, hey, yeah, I want to be the Fed chair, but don't fire Powell to make me the Fed chair because that would be unprecedented. So this is popcorn, must-see TV. Is it going to happen? Is it not going to happen? If I had to bet, I would say it's not going to happen because Bassent's keeping it cool. But if this does happen, it's going to create a lot more volatility for the markets. And as a result, we're going to have to see how the markets react if Jay Powell is replaced by Trump. Okay, next up is Netflix earnings. Netflix crushed it. I bought it at $9.75 and I sold it at $9.82. If I had waited like 5 minutes, I would have got to sell it at $1,000, but got a little $5 profit on the day trade there. In Q1, they beat expectations, 10.54 billion versus 10.52 expected in revenue, and 661 of EPS versus 570 expected. So a massive beat on EPS, a decent beat on revenue. But the most important thing for Netflix, which is why I'm very happy, regardless of how the stock performed, that they were able to put up these numbers to start off big tech earnings in Q1. Revenue guidance for Q2 beat. Revenue or EPS guidance for Q2 beat. And then operating margins for Q2 beat. All of those beating by around 20 to 40% on every metric. So I just thought as soon as I saw the report, like this was pretty damn incredible. These were numbers that I don't think the street can deny. Now, granted, Netflix is one of the best tech performing stocks year to date. In comparison to the other Mag 7 stocks, it is being pitched from what I'm seeing in the analyst community as a consumer defensive in a recession. People are not going to cancel their Netflix subscription, which probably is true, but I do think in a recession, maybe that multiple takes a bit of a haircut. Right now, it's trading at about 50 times earnings. Google, on the contrary, is trading at like 15 times. So from that perspective, I understand the thesis on Netflix. I got the thesis wrong a couple of years ago. I thought that they would be paying too much for content and YouTube would be better. And I think YouTube is better. It's just like a more creator democratized platform. But there is a premium offering for people that want to get content, not just from content creators, but from studios. And Netflix is the only profitable streamer that is able to consistently create good content that people want to see. And so it makes sense that Netflix is going to do well. There was a Wall Street Journal article a couple of days ago that said Netflix leadership estimates they can be a not a $10 trillion, but at least a $1 trillion company by 2030. And to do that, they would have to double their revenues. Currently, right now, they're doing about 40 billion in revenue. They probably want to get to 80 to 100 billion by 2030. Now, this is really important going into tech earnings because Netflix said they're going to double their ad revenue this year, which is good because we're hearing ad budgets get cut based on the tariff volatility. So that's positive. They didn't change their fiscal year 2025 guidance. They raised Q2 guidance, but they didn't change the overall 2025 guidance, which is really good because the tariff volatility is not stopping the ability for them to be able to monetize and still grow as a business, which is very important because we want these companies to grow so that we can allocate capital and get a return on that capital. And then finally, they said, hey, we're probably going to raise prices later this year as well. And we think subscription prices are going to go higher, which is a good thing because they believe they have the pricing power, the pricing elasticity to be able to say, if you pay $15 a month for Netflix, you would be willing to pay $17, and they think most people are not going to churn. They also stressed the importance of live games, WWE, NFL. Here's a good stat. Netflix accounted for 9% of all UK TV time in Q1, which was ahead of YouTube, which was at about 7%. So look, I thought it was a good earnings. Stock price was kind of up at 1.5%. Now it's up 2%. Like, I don't know where the stock goes in terms of the multiple, the macro, but to start off big tech earnings, I thought this was a hell of a quarter. They beat on every metric. They raised on their guidance in going into Q2, and they didn't say that they're afraid of a recession. Now, if we get a recession, everything else changes. But so far, to start off big tech, Netflix seems like they had an incredible earnings. Okay, next up is Nvidia. Nvidia CEO last night, Jensen Huang, I woke up to the story that he flew to Beijing. So Nvidia chips got banned 3 days ago. H20 chip banned from being sold to China. $5.5 billion charge off in Q1 that Nvidia said they would be taking. Now, 2 days later, Jensen is in Beijing. Well, why is he in Beijing? In my opinion, he wants to make sure that his relationship with the CCP is in a good standing because he obviously wants to sell a ton of chips to the CCP eventually. There is an indefinite ban. They have to get some new license. I think Nvidia is being used as a pawn in the trade war between the United States and China. So I don't know when that license is going to be granted, but that's pretty exciting, right? Like, Jensen is saying, hey, Trump's screwing me right here, even though I thought we had an agreement for him to not screw me, but he screwed me. So I'm going to take my ass to China. I'm going to make sure everything's good with them because I can't afford to lose this revenue, especially my stock trading at the multiples that I need to make sure we continue the growth and keep the AI revolution alive. Again, the H20 chip is significantly worse than like a Blackwell, but they designed it to be able to sell in China. So when the US says, hey, it's a national security threat, Jensen's probably like, come on, bro. I mean, Jensen's being compliant with the United States because he's being a good actor, but at the end of the day, he's probably very annoyed about this. So from that perspective, he visited Beijing and he had a couple quotes to say, and his quotes were pretty encouraging. Basically, Jensen was like, hey, I respect what the United States did, but I also feel that my relationship with the CCP is not bad. Specifically, he said that the U.S. tightening of chip export control has significant impact on Nvidia's business, even though they will comply with it, and that they will continue to strive to optimize their product lineup with regulatory requirements. My takeaway from this is very simple. He wants to make sure that the Chinese business is saved. He knows that there's going to inevitably be a deal with the United States and China. If there's going to be a deal inevitably, he wants to make sure that the relationships with Beijing are good and that Beijing probably doesn't give more precedence to ingrown companies in China like a Huawei that could be potentially building chips in the same time that Nvidia is banned from building the same chips or selling the same chips, which means Huawei could get a technological advantage before Nvidia has the right to sell these chips again, which may happen next week or it may happen a year from now. Like, no one knows. And so I think he went to China just to be able to say, I'm here. I don't agree with what the US did, even though I understand why they did it. We are ready to sell you the chips as soon as we get the permissions to sell you the chips. And you don't need China getting mad at you if the United States is already not letting you sell their chips. So I think to me, this was just a political trip that he had to make. And hopefully, eventually, Nvidia can sell back into China. But based on this trade war, it might take a little bit of time before that happens. All right, next two updates are on the healthcare sector. So first of all, United Healthcare, they fell 22% on the day. Worst drop since March of 2020. The stock lost $125 billion in market cap. The Dow Jones was down about 2% on the day, 1.3% on the day. And the United Healthcare is one of the top holdings in the Dow Jones. It's only 30 companies in the Dow Jones index. Nvidia is one of them. So when your top holding falls by 22%, that's obviously not the best for the Dow Jones. Now, why do they fall 18%? They cut their guidance for the full year. And my takeaway from this is that the cutting of the guidance is not enough, in my opinion, to be able to lose $125 billion of market cap. Like, I understand people being afraid of companies cutting their guidance and trying to like navigate the situation with the tariff volatility. My real takeaway here is that United Healthcare pulled a move that other companies might pull in the future, which is why it's important to understand what they did. They might be saying, hey, the tariff volatility is probably not going to screw us that much. But let's just say it is right now, deal with the 20% hit, and then just beat and raise. Because if the tariff volatility is not going to be as bad for the healthcare sector, which maybe it is, maybe it's not, I've got to do more research in terms of what the implications of that look like. But United Healthcare today is saying, hey, some of that volatility might not be the best. And the stock market's like, okay, cool, we're going to sell you off. If the volatility is fine and Trump gets all these trade deals and we're good to go, I mean, they can easily beat and raise, right? So from that perspective, is it a buy the dip? I've never been big on United Healthcare. It is an American staple. It's one of those companies that is part of the United States stock market in general. So it's like, I wouldn't get mad at anyone taking a stab at it at 22% down, but I also do understand that there's so many better opportunities that are exciting out there outside of UNH. Now, Eli Lilly was up 15% on the day. Why? Well, one of their drugs, orforglipron, I'm probably saying that wrong, which is their oral GLP-1 drug, aka the weight loss drug, successfully completed its phase 3 trial, showing significant weight loss and A1C reduction in type 2 diabetes patients. At the highest dose, patients lost around 16 pounds and saw their A1C levels drop by up to 1.6%. The key word there is oral, and that means that the street is really excited, or they were excited today, because Eli Lilly is about to come out with a weight loss drug once this officially gets through all the trials that you can swallow and lose weight. So, I mean, if you're a fan of Ozempic, if you're a fan of the injections of it, and obviously we've seen the massive level of demand that is created for a lot of these companies, Hims, Novo Nordisk, Eli Lilly, etc. Now, if you can eat a pill and lose weight, which is the most common way that people take medicine, they just swallow pills. That's probably relatively bullish for Eli Lilly. They were up 15% on the day. Next update, U.S. homes. United States homes are selling at their slowest pace since 2019, with the average home under contract in March sitting on the market for 47 days. So it takes about 47 days to sell a home, which is the slowest time it took to sell a home in the past 6 years. High prices, weak demand, and growing supply are cooling the market. Only 27% of homes in the month of March sold above their list price, which was the lowest share since 2020. The median sale price rose 2.5% year over year to now $431,000, which is the slowest growth in 18 months. We have mortgage rates that are just under 7% based on that 10-year getting to about 4.5%. last week. That's another reason we want rates to come down, because mortgage rates will come down. But it's pretty obvious the housing sector is struggling. Now, one good thing about the housing sector is that shelter inflation is coming down dramatically, and it's getting down to levels which were even below the pandemic, or very close to going below the pandemic, which goes back to Tom Lee's argument, which is, hey, shelter is falling off a cliff when it comes to inflation. You've got auto inflation that's coming down. You've got all these other different ancillary parts of inflation, energy inflation, obviously, with oil prices being down. I mean, inflation should be falling off a cliff. The problem is these tariffs might be more inflationary, which is why the Fed's not cutting. But we kind of need rates to come down, and mortgage rates uniquely to come down, to unlock the housing sector so that more people would be comfortable buying or selling a home. I mean, who wants to sell their home if when they go to buy a home, they have to pay a 7% mortgage? So from that perspective, not the best macro data in terms of housing starts being at their lowest level, and the level of time it takes to sell a house, and the listing price you can get to sell that house. But it does mean that once we get rate cuts, I think the housing market is going to have a lot more liquidity, and a lot more people are probably going to be buying and selling. Okay, last set of updates here. Google was down about 1% on the day. At one point, it was down about 3%, then it recovered 2%. A U.S. judge ruled that Google holds illegal monopolies in parts of the online advertising market. That was a court order that came today. This follows yesterday's news that I missed, where Google is being sued by the United Kingdom for £5 billion for basically the same thing, being an illegal monopoly when it comes to advertising. This partial loss in the antitrust case that Google's been fighting for the past 2 years now could force Google to break up sections of its ad tech business. That doesn't mean they're going to get rid of YouTube, Chrome, and Android, which I think would be the real bear case on this, but certain parts of their ad tech business might get broken up. Not a good thing for Google. Unfortunately, Meta is about to head into a massive trial with the FTC now as well. And if U.S. judges hold Meta liable for being an illegal monopoly, like they're saying Google is right now in the context of advertising, yeah, that could be pretty bad for Meta as well. It's just a question of how bad the violation would be in the context of what they have to break up. Schwab saw trading activity surge in Q1 with 7.39 million daily active trades on the platform. That's up 24% year over year and massively beat expectations. The firm added 138 billion in core net new assets, which is up 44% year over year. Total client assets reached 9.93 trillion. Schwab was up about 3% on the day. Why am I bringing this up? Well, in the context of Robinhood, which is a stock that obviously I care about a lot, and I know a lot of you care about the company. Robinhood's market cap is 38 billion, and they have just under $200 billion in assets under custody. Schwab's market cap is 150 billion, and they have 9.93 trillion in assets. Why is Robinhood getting the multiple and Schwab's not? Robinhood's growing. If Robinhood can keep growing, and they're not going to keep growing at this rate forever, but if they can keep that growth elevated, they're going to be worth way more than 150 billion one day. Schwab is almost 10 trillion in assets, worth 150 billion, but they're not growing anymore. Robinhood, if they can keep up with this growth, forget 10 trillion, but if they can even get closer to 500 billion, which is what IBKR has in assets, or closer to that $1 trillion mark, which I think can happen in the next 5 years, and they keep up this growth, Robinhood's going to be a pretty exciting company. So I just wanted to bring up that comparison because there's a lot of room for Robinhood to grow. There's many, many, many trillions of dollars of assets and all these new verticals they can expand into. Schwab is already pretty mature, but even if Schwab's growing, you could imagine that Robinhood, being innovative, more millennial, Gen Z friendly, they have a massive chance to grow as well. Final thing I want to talk about today, Bill Ackman. We talked about this yesterday a little bit, bought a 20% stake in Hertz. He issued one of his Bill Ackman long tweets today about why he bought a 20% stake in Hertz. And it comes down to fundamentally, I mean, there's some like numbers he gave about management changing this and operating margins going to go up and this and that and pricing discipline, yada, yada. Hertz, again, has been in the gutter for the past couple of years. Not only the stock, but the company really hasn't performed that well. The final sentence of what he talked about, I think, was the most important. He said, I believe that Hertz and Uber can have a fully autonomous vehicle rollout with Hertz's massive fleet and servicing capabilities, along with their physical infrastructure, as a natural fit to boost the vehicle utilization and long-term profitability that Uber would be able to supply them with as well. So what's happening right here is pretty obvious. He owns a crap ton of Uber. He wants to obviously help that Uber position. He's buying Hertz, and he's expecting an Uber partnership. He even tagged the Uber CEO in the tweet, and the Uber CEO responded, thanks for letting us know. I'm going to look into it. It's really incredible to see how this is playing out. One theory I have right now is that the SEC kind of doesn't care because it's Trump's SEC. It's the wild, wild west. And so as a result, you can kind of do whatever you want. And Bill Ackman is basically saying, hey, I got Uber, I'm buying Hertz. Hopefully they work together, and it is what it is. And if that works out correctly, Hertz stock probably goes up, Uber stock probably goes up. Bill Ackman makes a lot of money. All right, that's it for me. Thank you, everybody, for listening and watching. The Toronto meetup, by the way, I'm putting the link in the description here. It is happening on April 26th. I'll be in Toronto. So if you're in the region, you could sign up to that list. I will send you a Telegram group link. It will be from me in my email. And you can join that group. And then when I give out the details of the location, it will be on the 26th, likely the entire day, like 2 to 8 p.m. You can show up, meet up. We did these meetups in California, New York. It was super fun, exciting, good group of people that want to talk about stocks and investing. So if you're in T-Dot, I'll be there Saturday, April 26th. No stock market open or closed tomorrow or daily recap because it's Friday and it's Good Friday, so the markets are closed. But we'll be back starting Monday next week. Thank you, everybody. Appreciate it. I'll see you guys in the next one.